Selling strangles, how to collect some premium, possibly hedge if you're short a lot of them, the considerations and things that I take a look at today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. One of the things I thought we would talk about today, and the reason I thought we would talk about it is partially because my friend and colleague, Carter Worth, started this ETF, WRTH, appropriately enough, Worth, which sells strangles. There's a little bit of a wrinkle. It has to do with some of the rules associated with ETFs. And you could actually, I suppose, be naked short calls. In his case, at the moment, they're not naked short calls. They actually are selling call spreads and short puts. Mike is wearing military style today. Well, it's not quite military style. I'll actually tell you what this shirt is. I don't know if you can actually make it out. There's a logo. Where is that? It's on this side. There it is. So there we go. That logo that you're looking at is two pheasants or grouse or something like that, and a wine barrel. That is the logo for the Wing and Barrel Ranch in Sonoma, California, which you're welcome to look up if you're interested. I have a friend who's a member up there. It's about 25, 30 minutes away. Maybe a little bit more. It depends on traffic. But if you are heading up to Sonoma from San Francisco and you're going up the 101, you get off on a road called 37. You take 37 east. And right when that road splits, where Sears Point Raceway is, so the Sonoma racetrack is also right there. There is a ranch that is on the northeast corner of that intersection, a couple thousand acres. And they do things like sporting clays and fly fishing and stuff like that up there. Fun spot. They also bring in the rodeo. So the professional rodeo actually goes up there once a year. I think it's like in August or something like that. Anyway, and even more so when the kids were younger, we would go up there and have some good food and watch the rodeo or do whatever. So that is what this shirt is. You can actually make out the brand over here, Poncho. But I rather like this shirt. Anyway, not military style, but I guess a little sporting, or more sporting than you would typically find on the trading desk. But there we go. So because Carter Worth is doing this strangle selling strategy, I thought we would talk a little bit about some things that I think about. On my screen right now, I have a list of stocks. And there's kind of a lot going on there, and it's going to be almost impossible to make this out. So I'm going to blow this up a little bit so you guys can get a better look. So let me just make that like 200% size or something like that. There we go. Nice and big. You can see the names over here on the left. If it's highlighted in green, that means that I looked at this one and said, this might be a decent candidate for a short strangle. And I was not originally using the expiration that I'm using here, so if you probably might find it hard to make out, but I'm going to highlight this. So in green over here in the upper right-hand corner, you're going to see in that box that I've selected July 17th. So that's just regular way July expiration. When I first began to work on this, I was actually looking at June 18th. What are the things that I'm thinking about when I'm looking at these types of strategies? The first is that there is a natural temptation when you're selling premium to try to find the highest premium that you can. So, something that trades 40 vol or 50 vol or 100 would, by that calculus, be better than something that was trading, 25 or 30. I don't look at it that way. What I am interested in is avoiding the obvious sources of realized volatility, which are things like catalysts, such as earnings. So you'll notice that one of the very first things I'm doing here is taking a look at, okay, when are they expected to report? And I don't want to select anything where the expected report date is going to happen before the expiration of the options, assuming I'm going to wear these all the way in to expiration. But in point of fact, in many cases that won't actually make sense because these things will very likely decay away to a point where they should be covered well before then. All right. So if we're looking at this, the next question is, how far away should we choose the strikes? Now, I'm sort of doing this in a somewhat automated fashion because I thought I would be illustrating it today, and I wanted to have a lot of examples. So what I'm doing here is I am calculating the mean absolute deviation. What is the mean absolute deviation? The mean absolute deviation is just a statistical term. One way to think about it is the average move in terms of magnitude that would be expected based on the current price of options. What are some other statistical terms? Another statistical term is, the standard deviation. So standard deviation, if you guys are familiar, it's also a probability measure, a statistical measure of what the likelihood is that something deviates from the mean by a certain amount. One standard deviation, 68% of the time, two standard deviations, 95% of the time, and so on. The mean absolute deviation is a little bit different, and it's smaller than the standard deviation. How much smaller? It's about 80%. Now, we can get into the particulars, but it really isn't necessary to do so. If you take the standard deviation of a distribution and you multiply it by 0.8, you're going to approximate the mean absolute deviation. It's actually slightly less than 0.8. The actual number is that you multiply the standard deviation by the square root of 2 divided by pi. It's not really a whole lot more important, though, than that. That number turns out to be very close to 0.8, or 80%. Okay. Justin Matthews, been wanting more info on executing better on strangles. Okay. So as I was thinking about this, I thought, okay, that's a good starting point. So what I did was I created a spreadsheet that allows me to put in any expiration that I like. It takes the 30-day implied volatility. It calculates the mean absolute deviation based on that between now and the expiration I've chosen. So the mean absolute deviation will be larger if I go further out in time. It'll be smaller if I go closer in time. In this particular instance, it gets me pretty close to 6 weeks, 6 to 7 weeks, 6 weeks from Friday to be more precise, which, as it happens for people who are followers of Tom Sosnoff and Tony Batista and people like that who've done some work on this, and it doesn't necessarily have to work like this, but if you like that as an approach, what it's going to do is it's going to take the mean absolute deviation, which you can do yourself. So all you have to do is you choose the expiration that you want. July. You figure out what the implied volatility is. So for this one, and I didn't select this, so Tigo, Millicom, Cellular, this was not a name that I thought this really appeals to me. Aramark, which is they do like food services stuff. I didn't highlight that one as green either. But why don't we work through an example together so we can kind of understand it. Why don't we take a look at Dix? So Dix is not slated to report until August 28th. And let's have a look at Dix's chart. And we're going out to July now. So this is going back for, what is this, 1 year? Is that, yeah, it's not quite 1 year. So let's go back 1 year. And now we're going to go all the way out to July. So I want to get July in here. So that's going to be July expiration. Is that about July expiration? July 20th? Good enough. All right. So let's see what it shows based on what I just said. So we're taking a 40% implied volatility. Now, the first thing to do if you're trying to take an annualized volatility number and convert it to a shorter period of time, the first thing you need to do is you have to adjust that. Well, I mean, you can take this number and do the mean absolute deviation calculation first, or you can do, adjusting for time first. Either way, it doesn't really matter. It's an arithmetic calculation, so it doesn't really matter whether you multiply by 0.8 before or multiply by 0.8 after, but we'll do it after just to sort of work through. So the first thing is, if you know that the standard deviation for a stock is 40%, I'm rounding, 40% for a year, what is it between now and July expiration? So to do that, we need to say, okay, well, and here too, I'm going to just jack the size of this so it makes this sheet really easy to read. So I'm going to make it nice and big. All right, so 40% is the annualized standard deviation. Okay, let's go like this. So I'll label everything so we can all work through it together. 40% annualized standard deviation. What is it between now and July expiration? Well, okay. The first thing we need to know is, so we'll take July expiration, which is the 17th, and we'll put today. And we're going to subtract one from the other. This has 46 days. So I now take the number of days in the year, which is 365. If you want to be really precise about it, you could do that, because that's calendar days, not trading days. You can do it by sessions also, but in this case, so I do this, and I want the square root of that number, and I get this, and I divide that by that, and now 14.2%, that is the standard deviation. If it's 40%, that's the standard deviation going to July expiration. If this was 60% implied vol, you can see how that changes. If this was June expiration, you can see how that changes. But we're looking at July. There we go, 14.2. All right. Now remember what I said. If you want the mean absolute deviation, that's going to be equivalent to this number times the square root of 2 divided by pi. So that is equal to that. Oops. I hate doing that. Okay. So the mean absolute deviation is 11.3%. There we go. So 11.3% of Dick's, we can round it, but it's going to be about $22, right? Maybe close enough for government work. We'll call it $22, higher or lower. So that's going to get us to, maybe 195 on the downside. We'll draw a line at 195 or thereabouts. And it's going to be, again, we're going to add $22 and change. So that's going to get us up to over here. And that gets us a range that's going to look a little bit like this. Okay? Now, just to put things in perspective, you can see just how far out that gets us, right? So that might be a little bit high in terms of because we might expect it to run into some resistance. So you might say to yourself, you know what? I really don't think it's going to, exceed the prior high between now and July expiration. And you might say to yourself, you know what? I'd be more comfortable if I chose a number a little bit lower. Maybe you do, maybe you don't. So you can make a minor adjustment. But that essentially gives us a range. Once we have that range, we can now take a look and see what kind of return something like that might generate. So we'll go back to Dick's here. I have annualized this number. And you would collect about $7.33 to sell that strand. Actually, look at this. I have an even wider number here because I was rounding and I asked it to round to the nearest tenth. So 180, 240. That's actually really wide. So let's go back to that actually. So that's the one that I came up with. My system, like I wrote it, so it's not doing it manually. So I'm going to delete this, delete that. So 24% annualized is a range, in this case, of 180, which is actually below. It's 240 to 180. I mean, it's actually, so the strangle that gets you 24% annualized is actually up here someplace and down here. All right, so you're making money anywhere between those levels. Now remember, you're short the 180s and short the 240s, but you're collecting $5.30. So the real break-evens are going to be 245. This is 240 right here, so 245. And this break-even, what is this down here? This is 185. It's going to be 175. So your downside break-even would be down here someplace. So you're basically, you're doing that. You're willing to get shorted up here, and you're willing to get long down here. There's no earnings in the middle, and that'll pay you 24% annualized, okay, using July expiration. That's 24% annualized if you ride it all the way in. You're assuming that you need to. The question is, do you need to? Well, why don't we take a look at June expiration and see where that 180 put is and see where that 240 call is. Because that's going to give you a sense of whether or not you'd have an opportunity to cover this structure well prior, right? So there's going to be some decay that takes place. How much decay? Well, let's see. So the June 240 calls. Those right now are about $2-ish. And the 180 puts, mid-market, we can decide what we think the appropriate, 55 cents or thereabouts. So effectively, this whole package would be $2.50. Remember, it's, what do we say it was now? $5 and change. Oh, no. Is it more than that? Oh, yeah. No, it's $7. Okay. So that's, the Julys are $7.33. So you will have made most of that return just with that passage of time, right? So, after 4 weeks, by that analysis, you could close it and rebalance if you chose. Or just close one side because, unless it goes dead sideways, one of those things is probably going to become worthless, at which point you could cover it. And then in the off chance it goes the other direction, you can cover that side too. Okay. So that's sort of a standard approach that one could use as a starting point. And everything that you see here, all of these ones that are labeled in green, are names where I went through this initial work and then looked at a chart and said, okay, you know what? Those look like reasonable levels to get long and short. So now we can take a look at, say, Google, for example. We'll look at Google. And my levels for Google were 340, 410. So 410, is that probably, where is it going to be? Up here somewhere. That's probably the prior highs or thereabouts. And 340. So we're looking at that. And again, this is between now and July. So I'm going to get July in here. Let's see where we are. Yeah, so you're looking at 410, and that's not including the premium, 410 and 340 with the levels for Google. And Amazon, 230, 290. I'll let you guys decide for yourselves. So 290 is going to be up here. And what was my other one? 230, yeah. So 290 up here someplace. 280, 290, we'll guess it's about there. And 230. Those look like pretty reasonable break-evens to me. I assume they probably do to you as well. And so on and so forth. So I have a whole bunch here. I mean, I will, if you want, I mean, I don't know how much this helps you. I'll just very slowly play it at half speed, quarter speed, pause it. I don't care what you do. You know, here are some of the names that I was looking at. Some of these ones that are in yellow, I looked at it and I thought, well, they're kind of compelling from a return standpoint, but I just couldn't get comfortable with the levels. And I didn't go through every single one. Now, this I have to get rid of. Now, this is where it gets kind of interesting. And I'm going to guess, maybe not. I'm going to guess that people have probably not spoken to you all very much about, well, that's all fine. Reasonably good probabilities of profit, fairly attractive rates of return. But what if we get a crazy post on Truth Social? What if the market suddenly drops 15% in just the next several weeks during the period that we have these positions on? What if it suddenly rips by a like amount? What do I do? Well, the answer is, one of the things you could do is you can hedge. How do you hedge? You use index. And for our purposes, the index that I'm going to use to approximate, you know, a reasonable way to approach this is going to be SPY. So I have a line here for SPY. And what I did was I said, okay, well, let's assume you did kind of the same thing, except that you're going to be doing the inverse in this case, right? So I want to be down one. I'm going to buy a put that's down the mean absolute deviation. Same thing as I'm shorting in the other case. I'm going to buy that. I'm going to buy the upside call. Now, because there's a lot of skew in puts, what I'm really trying to do here is say, okay, well, if the move down is from one mean absolute deviation, one mean move lower to two standard deviations lower, I'm going to buy that put spread and then buy the upside call in SPY. And what that is going to do for me is it's going to effectively hedge against the really wild outsized move. So if the S&P moves more than the mean absolute deviation lower, I will have some measure of protection. Now, I'm not buying complete protection. I am going to buy partial protection. So I'm going to buy that put, that's the 725s. I'm going to sell another put against it. And then I'm going to buy a mean absolute deviation call a little bit higher. That turns out to be the 795s. Now, if you're looking at these prices, it turns out that the 795 calls and the puts that I'm selling against these long puts are about the same value. So it's about $5.50. So that's going to cost me about 5% annualized for that insurance. So own an upside call on index, own a downside put spread on index, short strangles on constituent stocks. And the average annualized return for all of the strangles that I've identified here is about 23% annualized. And the cost of that insurance is 5%. So that works out to 18% annualized rate of return, assuming that things kind of hold together. Now, the reason I'm doing this on a big basket of stocks is because you can't do this if you're just simply going to do one-offs. Like I can't say, "Oh, I like this. I like this. I want to do it on Google." Or I just want to do it on Amazon, or I just want to do it on Dick's. So I'm just going to do one of those, and then I'm going to go and trade the S&P as a hedge against it. Well, the S&P is not a great hedge for the idiosyncratic risk that accompanies doing a trade like this, getting short vol in a single stock. You need to have a fairly diversified portfolio for this to work. So you can see I have a broad, Alphabet, That's communications. I mean, most of us think of it as technology, but technically that's in the communication sector. I've got Amazon. I have some consumer discretionary in here. We had, I didn't get to it. It's not in the list. There it is. Yeah. So I didn't get to analyzing it yet, but we've got some industrials in here. We've got Caterpillar. So the idea is that once you have done something like this across a broad swath of stocks, and that they're not just tied to a single sector, then you can look to hedge it with something a little bit more generalized, like SPY, for example. You could, if you chose, I suppose, say, well, I only want to do it on NVIDIA. I want to do it on Texas Instruments. I want to do it on, let's pick another sort of similar type of name in here. I'm not even sure that there is one. Maybe Lam Research. Well, if you're doing it on Texas Instruments, NVIDIA, Lam Research, and ADI, Analog Devices, I'm going to throw I'll throw Amphenol and I'll throw those names together because they exhibit a lot of pairwise correlation recently. Would SPY be a good hedge in that case? And the answer is no, not really, right? So if you find yourself saying, okay, I'm scrolling through Mike's list of stocks, or I'm going to use this same approach myself, and I'm going to say, okay, well, I want to sell strangles on stocks, but I'm only really interested in doing utilities, which are going to have lower vols, by the way. But let's just say, for the sake of argument, the best mechanism for you to hedge is going to find something that is more closely correlated to that index. Because here's what's happening. When you get short a whole bunch of single stock vol, so you're selling all of these strangles or straddles or however you decide to affect the trade, when you are short convexity, when you are short gamma, when you are short options in all of these single stocks, if you are looking to hedge at least against the exogenous sort of geopolitical macro risk to that sector, get sector exposure, right? What you have decided to do if you do this trade is you are saying, you know what, I'm willing to take the idiosyncratic stock risk, but I want to hedge out sort of the macro high correlation risk. And, oh, by the way, if you're wondering, well, how much do I do it? I mean, a simple way would be just simply to take the total notional amount and make it the same. So now that kind of works. And the reason it's kind of going to work is because there's a little bit of a self-correcting factor that is built into this. By virtue of the fact that I've done a mean absolute deviation calculation for each of these constituents and for the index itself, I don't really need to do a secondary step that says, okay, well, what's the beta of this stock versus that one? Because that's kind of baked into the calculation already, right? So the mean absolute deviation for a highly volatile stock will be larger than it is for one that isn't. And we can see that simply by taking a look at the percentages, but you saw the math, right? So you could very quickly see that. So if I find I do 20 stocks and I do $50,000 worth of notional exposure on each one of those, then I need to have $1 million worth of notional exposure on SPY to hedge. Assuming that I can keep the construction of this whole thing relatively consistent with the weights of those respective sectors inside of SPY. So if I choose 20 stocks, does it kind of represent what SPY looks like? That's kind of the way you're going to look at this. And these days, technology is a much bigger weight in SPY than it has been historically. Okay, so I think that's as good a place as any to fire off. Alex V says, 2 security firms reporting this week: Palo Alto Networks and CrowdStrike, and retail, Macy's and Lulu. Yes, we did a trade, or we talked about one last week, in a cybersecurity stock that got slayed at first and has subsequently bounced back. I am talking, of course, for those of you who watched us last Tuesday, about Zscaler. So Zscaler, interesting one. I actually did a write-up on this one for CNBC as well. But as you can see here, the trade that we had actually talked about was a short 155, 150 put spread. Closed today at 155.2, so that is still out of the money. And the trade that I had actually advocated on CNBC was a call spread risky for a small credit. And that was like the 165, I think it was 165, 180. Oh, no, it wouldn't have been 180 because it would probably, well, I don't know. Actually, this, I kind of remember it being the 180s. I'd have to double check. I probably wrote the thing and then, you know, maybe the stock moved. Yeah, because I think I wrote it before the stock opened on Monday. This is interesting, though, because it's pretty clear that ever since this point here, it's sort of been finding its footing. And now it's look at this. I mean, it's only 3.3% lower than it was 10 trading days ago, despite that enormous gap lower, which is kind of interesting. So yes, definitely getting some of that stuff. FinWest, welcome to another month. Thank you. That reminds me. Yeah, I have to put something in because it is the end of the month. Ambassador, how are you, sir? I am testing out a new trade. Love your thoughts on it. And Alex V, I think you're asking me about Wing and Barrel members only ranch. It is, yeah, it is. It is members only. I think I talked to the membership folks up there. I think they just jacked their fees. By the way, so I believe there is some availability for anybody who lives in the area. And you know what? I don't know. It might be cheap. You know, some clubs are cheaper if people live further away, because obviously you're not going to avail yourself of the club as often. I don't know if that's true for Wing and Barrel. What I can tell you is it's a great spot. They have good food up there. It's just a really nice place. But I think they recently raised their initiation fee or something like that. Okay, so let's see what else we've got here. Justin Matthews, I've been wanting more detail on executing better strangles. Okay, yeah, so hopefully this helps. Jim Howard, Comcast fundies are generally in decline. Perhaps short-term bounce options trade 20 to 40 days to the long side. Technicals appear oversold. Upcoming shareholder meeting on June 10th. World Cup. I'm not sure. Well, let's take a look at let's just take a look at what the technicals have to say first. So we have so a couple of these, yeah. So stochastics, which let's look at this one first, because that's the best performing. Looks like it triggered and went short over here back on what? Oh, that's hard. You know, that's really annoying. Oh, I actually see down at the bottom. So that was April 22nd. Was that the start? That was the day that, yeah, so it got it. I actually can't quite make it out whether that's the day that popped or no. I can't. Let's see. Is that the 22nd? 23rd? Okay, so it actually, I mean, the timing seemed a little bit rough. So it would have sold and went short right here, right before you got a nice pop that day. But it obviously turned out to be a good trade. See, we'll go down to the next one, RSI. See what RSI's got to say. So this is interesting. So on an oversold basis, you may be right, you're getting close. You can see here that RSI indicated that it would have sold and went short over here when, and by the way, don't forget, I'm using for RSI, I use the default settings, which is 14-day 30-70. But to your point, it's getting awfully close right here to oversold. I mean, what did that get down to? Let's see, I mean, it got awfully, awfully close, didn't it? Didn't trigger, but it's probably needs to sell off a little bit more before it does here. And let's take a look at our next indicator. See what this one's doing. Fear and greed sold off here. Is this getting close? Might be. Looks like it's about to pivot. And the Rex oscillator, why don't we take a look at this one? This is much more short dated. So yeah, I mean, it looks like a mixed bag to me. As you guys know, I tend to look more at longer trends, which is going to be over here, and that doesn't look so hot. I don't see, looking at this, I don't see any reason necessarily to pile in. But if you're looking for a trade, 20 to 40, and you said, oh yeah, let's just all double check what Bloomberg has to say about the. And there's the annual meeting. You were referencing that right here. 9 a.m. on June 10th. And it's true, those things can sometimes create a bounce. Low vol name, typically this, I think. Well, not that low, not as low as I might have thought. Mid-30s. You know, maybe a call spread risky would be a way to play that. Let's build one. So, more easily justified by its 35% implied volatility. So we'll do this. And we'll run out a similar length of time. So I'll just do a combined chart. And we'll go out to, since we were talking about it already, why not? Go to July. You know, well, that's interesting. Why is the 25 strike showing up twice there? Sure, so. Not sure what you think the rebound would be too, but we could get those calls. Gonna have to watch your limits on this one. This is closing prices, so they might just be a little bit wide there. This is using a mid-market assumption. That's a net debit of 80. And maybe we sell something like 24 is, I don't know, actually. Doesn't excite me a whole heck of a lot. Oh, actually, look at this. A lot of the strikes are getting double up there. I wonder what's that's about. That would be about another 10% to the downside. Something like that would be, you know, interesting to me, potentially. Arguably just buying, you know, I don't know. I mean, if you have the stock, I wouldn't bother to sell that put if you own the stock already and you're just looking to give yourself a little bit of a boost. Seems likely that it's going to run into a little bit of resistance right here, probably even here actually. So you don't mind getting short those call strikes, assuming you can get something for them. And what is something for them? I mean, this 30, I don't know if you can make this out. You probably can't. But I'll tell you what it says if you can't see what that says. That's 43 cents, which is, you know, well more than 1% of that strike price. So, you know, you're talking about 12% annualized anyhow to sell that call. So it may not seem all that compelling. You're saying, oh, well, why do I want to sell an option for 43 cents? Well, it's 43 cents on a $25 stock. Takes your break even down, takes care of some of that instantaneous decay from one day to the next. That's what gives you the shape of this curve. This curve right here. If you're looking at this chart, that's your instantaneous performance relative to changes in the underlying. Of course, as expiration approaches, that curve becomes increasingly shaped like the break even right there. And this whole package, you know, you can see that you're essentially cutting, by selling that call, you're essentially cutting the cost of this package almost in half. So that's one way I would think about playing it. Okay. Eileen, thank you for showing us that calculation. Yeah, I mean, it's not too advanced stuff, but I think it's helpful to have, when you're looking at strategies like this, it's helpful to, you know, have some of the basic math that's going into it, and, you know, get some sense of, you know, why you're choosing the strikes you are and what you get for it in exchange. And, you know, I think this is a very attractive rate of return. I mean, if you put this whole package on, right? So everything that I have in green, you sold those strangles, and maybe a couple other ones that I didn't manage to get around to before. This one's a little bit, you know, some of these commodity names could be a little bit sketch. But this, I mean, the thing about NVIDIA is that NVIDIA is such a meaningful and important part of the market now. I mean, it's, what, 8-9% of the S&P anyway. So if you had a portfolio that was built out like this and you traded your SPY as a hedge against it, that's going to be a pretty good hedge, right? Because it's, you know, it is a meaningful portion of it. Some of these other names, the same thing with Google, same thing with Amazon, you know, something like a Ralph Lauren and some of this other stuff, what you're banking on is just the fact that stocks trade together somewhat, but not necessarily the fact that that specific stock, Ralph Lauren, is going to have a meaningful impact on the S&P one way or the other. It's not going to. It's not a huge constituent. But some of those other names are. So you can get pretty tight relationship if you've replicated with those stocks. I think did I have Apple in here too? I think I did somewhere. There it is. Yeah. So, I mean, if you had just those stocks, right? So if you have Apple, NVIDIA, Google, Amazon. Did Meta fall into my list? Oh, I screened out Meta. Why did I screen out Meta? Must not have liked it for some reason. Was it technical? Oh, it was technical. As you guys know, I'm not crazy about buying stocks below their long-term moving average. I knew their fundamentals aren't broken. Top line growth, bottom line growth, margins, all good stuff, but technically it's a little bit impaired. So that one did not make my list. If it did, I mean, you'd have almost perfect basket replication there. Just throw in a little Tesla and you're good. Basically have the whole thing. Okay, MDM. Hi, Mike. Could you also just use 5 or 10 deltas to establish the strangle boundary strikes? You could. The deltas are higher, though. So the mean absolute deviation, the boundaries for a strangle that's struck at the mean absolute deviation is going to be higher than the strikes of one standard deviation. So here's a couple things to think about. One standard deviation, what do we know? One standard deviation, 68% of the events in the distribution are going to fall within one standard deviation, higher or lower. We can use that to assume that the absolute value of the combined deltas of the call and the put, assuming they're each a standard deviation away, is going to be give or take about 32-ish deltas, right? It would have to be. Because we also know from the math that the delta approximates the likelihood that the underlying is going to be at or through a strike on expiration. So by definition, if I have 68% of the events taking place within two sort of boundary prices, and then that means that the combined absolute values of the deltas should be somewhere close to 32. The mean absolute deviation is 80% of the standard deviation. So that actually brings the combined deltas to something probably closer to 37-ish, give or take. So if we know that the combined deltas, the absolute value of combined deltas is about 37, that's the same thing as saying 18.5 deltas on average. So 18.5 deltas on average, and again, we're just, doing sort of back of the napkin-y heuristic type of work here. But what that means is that the deltas that you're talking about, 5 to 10 deltas, that's going to be much farther away. If you chose a 5 delta short put and a 5 delta short call, absolute values again, that's going to be much farther away than the ones that I'm talking about. And consequently, the returns, and I'm calculating the returns based on the spot price of the underlying, is similarly going to be much lower. Let's go through an example just to illustrate that point. Okay, so let's look at Alphabet, for example. Again, we're looking at July. So we'll go to Alphabet, July. And here's the thing, so part of this, there is a preference element. The preference element comes from people selling options and many will do so with a significant desire that there's virtually no risk that they ever get assigned. So they're willing to collect oftentimes considerably less in exchange for which they have a much higher degree of confidence that they're not going to get assigned on the short option. We'll get to that in a second. But if you do that here for July, so you were talking about, what were the deltas? 5 or 10 deltas. I mean, even 5 deltas is pretty far. But here's a 10 delta option, right? So the 10 delta option is going to be, for July, the 10 delta put are the 325s. And the 10 delta calls are going to be the 445s. Right? So 445 on the high side, 325 on the low side. Now, that means that you're setting your boundary conditions over here-ish. Yeah, it's a little higher, somewhere in there. What did I say? 325, so it's going to be down here. So this is basically the range that you're saying is your sort of your zone of safety, if you will. You're saying, I don't think it's going to go outside of that box. And I would agree that I think it's a very good chance. The options market is telling you there's an 80% chance it stays inside that box. And for a lot of people, that's what they want. I'm actually going to frame it a little bit differently, though. And I'm going to say, would you ever be comfortable taking the risk that you are long or short Alphabet? And the answer to that, I would assume, is yes, right? So if that's true, maybe you don't mind a box that's a little bit tighter. My box is, I've already forgotten. Let's go find what my box was for this one. And by the way, a box in options terms is not the box I'm drawing. A box in options terms is combos of the same expiration and different strikes. It's a financing trade in SPX most commonly. You buy or sell the box. You buy the box if you're providing financing, and you sell it if you're looking for it. It has to do with basically the margin. You have to post all of the premium. So if I'm net long a lot of premium, I always have that as a minimum post. So if I sell a box in SPX, I can offset the premium, and I'm just going to basically pay the risk-free rate for the difference. So that's a box in options terms. 2 combos, long one, short the other, same expiration, usually traded in something like in SPX. The box I'm talking about, though, in this case, is actually the 3 340, and of course I already forgot because I was screwing around with this, but we're going to do that. Was the 340, scroll over, 410. So that's a much tighter range, but I'm also collecting a decent amount of money. It's really going to be 420. So, because I'm getting 10 bucks for it. So I'm really looking, oh, no, I didn't do that nicely. Let's do this. So we're going to go 410 plus 10 is 420. That's going to be 420, right about there. Okay. And I'm going down to 340. So plus 10, so it's 330. So my box that I drew is going to go in here. Now, you may say, well, that seems too tight. Could I see it getting above the high side of this and below the low side? Yeah. Okay. I'll go along with you there. There's obviously a much better probability that that's the case. But how much risk am I really taking? The risk I am taking is that I get long the stock down here. And then I'm going to have losses, percent for percent, as it falls. Or I'm short at this level, and I'm going to lose 1% for 1% above that level. Those are my break-evens. And I don't think, stocks move around. You're already taking this kind of risk. You take this kind of risk when you own any stock. Here I'm saying you're going to take that risk if it goes down, and that seems to be an acceptable one, particularly if overall you're still running a hedge, if you have this going a whole lot of times. Where you want to set those strikes farther apart, because some people will say, well, I only want to do this on 1 or 2 stocks, so I'm not diversified. That changes things. Because the minute you say, okay, I'm only going to do this on 2 or 3 stocks, and I'm going to use all my capital to do it, that's the same thing as saying I'm going to take the risk that I either go long or short 33% of my tradable capital in a single security. You have 20%, 20 constituents in your portfolio, you have a well-diversified fund. You probably have 90% of the benefits of full diversification if you have 20 stocks. 80% at 10, 90% at 20, and you're basically fully diversified, assuming that you didn't just concentrate heavily into a sector at 30, right? Beyond that, you're starting to minimize the benefits of diversification beyond that. But if you want to use 5 or 10 deltas, that's fine. But at 5 or 10 deltas, your returns are going to come in because you've decided to take less risk. But that's wholly up to you. Anil, what do you think about Microsoft? How can I manage my diagonal spread? And your diagonal spread is, let's load it up. Let's build it. What do you got here? You are short the June 425 puts. Oh, so you're long a calendar put spread. You're long July, short June. So you are short the June. I'm assuming this is just June regulars, which is June 18th. Why is that? Okay. June 18, 425 puts. So you're short these. And you're long the July 430s. And so you are long these. Well, today's move up 2 1/4, 2.3%, probably not the best for you because that's definitely a short delta trade. What were those Junes worth? 264. Yeah, I mean, you can see what you have here. It's kind of like a fly. Let's take a look at the technicals. See what we get. Broke above the 150. Could be a fake out, but I wonder. It looks like it finished pretty concretely through. I mean, technically, it's not a great spot for this trade because you're betting it's going to go lower. You're targeting your short strike, I assume, which is 4.25. And this thing is now trading 23 times full year earnings. And I say full year earnings because basically this is the number I'm looking at right here. $19.50 of anticipated adjusted EPS over the next 12 months because their fiscal year, as you can see, ends in June. So I'm just rounding that up, calling it 20. It's 23 times with still 16% top line growth. The big CapEx number, I guess people could make a fuss about that. But the fact that they're ramping their CapEx so materially that Alphabet said that, it was big, we're going to make it bigger, suggests that they've figured out ways to monetize it. Not a name, Microsoft's not, it's not on my big list of stocks to be short here. I prefer Alphabet, and I think I prefer Amazon, but this is still a name that I like. I'd rather be long than short, I guess. So I don't know if you have this against a long stock position, but yeah, I mean, I probably, one thing you could do let's see what the vol is here. Is this an attractive vol to sell? It's pretty chunky, actually. Here, too, this is kind of like the other case. I mean, you can see that 1 month implied volatility is definitely high, above the average, see? We're at 33.4 versus 25.6. Let's look a little further back. Not a bad vol to sell. What do they have on the calendar? I might think about selling an upside call spread if you're trying to lean into your trade a little bit more because like I said, I personally, not a name I'm interested in being short. Just broke above the 150. Did it break above the 200? That's something else we probably want to see. Let's see. No stock position. We're at a critical juncture right here. So it's basically right on the 200. If it breaks definitively above this and then comes back to it and doesn't break through, I think Microsoft's in a good spot. I wouldn't want to be short. Now, because implied volatility is reasonably high, and because they don't have, let's see what we have on the calendar. We've got earnings on the 30th of July. That's after July expiration. I might think about possibly selling an upside call spread to help, offset some, just because the vols are good. But, you say, would you rather? Would you rather be long or short Microsoft here? I got to go with long. So it's hard for me to recommend sticking with your trade because it's bearish. The only thing that's good about it is that it on a standstill basis, it's going to hold in there. Well, here's the way to think about it. Look at where the stock is right now. You're looking at this and you're saying, I don't believe it, right? So Mike just showed me a chart where he's saying, I think that they're recovering and it's going back above the long-term average. It went above the 150. It looked like pretty definitively and above the 200. So Mike's saying that he thinks that, it's back to sort of recovery mode potentially, and you don't believe it. If that's your thinking, the trade you have is as good a one as any. The reason being that you're at least getting paid to wait. So that's the good news. That's kind of the only good news, though. So I hope that helps you. And on that such an enormously cheery note, I have now chewed up an hour of your valuable time. And for those of you who stuck around for it, I really appreciate it. Oh, and I'm going to quickly just see if there's some answers I can, because I missed this. Is HP the next parabolic move? Looking at Dell, I wouldn't mind chasing it here. So I don't know that HP is anything. I'm assuming you're talking about HPQ, Hewlett Packard, and not Helmerich Payne, the energy company. Could it be? Could it be? Indeed, and it just broke out above its prior highs. So that seems promising. Wow, another one where the options prices have just gone through the roof. Call spread riskies for even. That's my way to play that, because worst case, with all this high, you're going to end up being put the stock at a much lower level. Was there anything else? That is it. That is it for today. All of you guys who stuck around, thank you very much for your time and attention. Like, comment, subscribe, tell your friends, and come back for the next open mic on Wednesday at 4:15. And actually, we're going to have Dom and hopefully Mark on tomorrow at 2 as well. See you soon.